How to become a millionaire. Plus, what's the relationship between the PE ratio? First of all, what's a PE ratio anyway? And interest rates. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a variety of networks throughout Central Florida, along with a bevy of social media channels. So make sure you subscribe to us on your favorite podcast channel of choice, or maybe even perhaps our video platform on YouTube. Just find us at Nelson Financial Planning. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So I guess we need to talk a little bit about sort of the markets, because one of the things we talked about on the program last week was that volatility may in fact be a part of the markets here in the fall. If you sort of look at the pattern of what's been going on a daily basis, we described it last week as sort of this boxing match between consumer demand and inflation / the potential of higher interest rates. To recap what we talked a little bit last week, we just want to start the program reminding people of that, because once again we saw kind of that volatile chop to the markets this past week. Two things, right, when it comes to volatility. Number one, volatility includes both up and down, right? So you can have some down days, which are obviously the ones that get exacerbated by the media. So you only think that those are the only ones that are happening. But then similarly, and oftentimes of late, like the very next day, you can have days where the market increases quite dramatically as well. So remember, number one, volatility has both up and down. And then number two, volatility loves company. As we said last week, when volatility comes into the market, usually hangs around for a little bit. So don't be surprised if this chop sort of continues on for the next few weeks here in the fall season. Number one most important thing to remember, though, when it comes to volatility is to be consistent. Really try not to let this chop throw you off from your long-term investing goals. Those investing results are achieved over time, and ultimately it is time in the markets, not timing, that produces the best possible investment results. Speaking of volatility, let's talk a little bit about what happens when people inherit money, right? Nothing like the volatility of a family fighting over the almighty dollar. And so we wanted to spend a moment talking a little bit about what a will won't do. Oftentimes people think of that as the document that sort of sets the stage for who gets what, and it certainly is, but remember, it's the document of last resort. By having a will, you're not going to avoid probate. It is in fact the document that provides the blueprint for probate itself. That's what a will is. It's a blueprint for that probate process. And the reality is, most people don't quite appreciate this, is that that will very much may be overruled by beneficiary designations or state law. So there's other things at play that would really rule that will, in essence, inoperable in terms of who gets what for the investment. So if you think of it, some of the major assets out there that people have, you think about retirement accounts, right? So a retirement account, you could have a listed beneficiary, or you could even have a default option that would apply if no beneficiary is listed, both of which would trump whatever your will says. That's true on a retirement account. Life insurance policy, same thing. If you name a beneficiary, doesn't matter what you say in the will, a beneficiary named on a life insurance policy is going to become the owner of those life insurance proceeds. And what's interesting here is, particularly when you think about life insurance, some states, Minnesota being one of them, has a law in place that says that if you leave your ex-spouse on as beneficiary, they will simply revoke that designation. But that's really only true in Minnesota. Many other states, that designation on that life insurance policy is going to stand no matter what, and no matter what your will says. Same thing true on bank accounts, right? So if you've got a joint registration on a bank account, hey, the joint owner is going to get it. Doesn't matter what your will might say. Similarly, if you've got a transfer on death, a payable on death on any bank account, or for that matter, really any investment account, whoever you have named on there is going to get it regardless of what the will says. Same thing on real estate. Titling prevails, so that if the real estate is titled as a joint tenancy with rights of survivorship, then ultimately whoever is that joint owner is going to be the one to get that. So state law, and even here in Florida, there's some spousal rights, things like that can come into play. But bottom line is, the will is really just a nice piece of paper when it comes to some of the other titling, registration, and beneficiary requirements that are on other types of accounts. So make sure that you really think about some of these things that we're going to describe next, about some of the tips, if you will, to follow to make sure that you don't render your will, or frankly just your wishes in general, completely inoperable in comparison to what you actually want. So there are 5 things we want to share with you on the program to make sure that you're getting it right. First and foremost, if you've got that registration form or that account application or that beneficiary form, make sure you take the time to fill the form out completely. Include things like social security numbers. Yes, I understand sometimes it's weird. Why does this institution need to know the social security of my remote cousin? The reality is that helps to identify who that person is. So before someone's going to pay somebody money, then they're going to want the social security number, or at least some other type of identifying documentation to confirm that. So fill it out completely. If it asks for social security numbers, dates of birth, things like that, be prepared to write those on the form. Relationships, addresses, and percentages, all of that needs to be completed properly on the form. And then the other thing to remember as you're looking at these forms is that words matter. So you've got to be precise in terms of how that form is going to be filled out and what those words mean. If I'm a primary beneficiary, then I'm going before everybody else. If I'm a contingent beneficiary, then I got to wait until the primary beneficiaries have all passed before I can then step up as the primary beneficiary. So it's really important to sort of understand that distinction, and don't, if you got 3 kids, don't name one as primary and the other 2 as contingent. That's not going to work, because the one you named as primary is going to be the person that gets 100% of the account. If they want to share it with their 2 siblings, that's going to come out of the goodness of their heart, but it's not going to be required. So understand the importance of filling it out and using those words as precisely as possible. Another thing to consider is this notion of per stirpes versus per capita. A lot of beneficiary forms have a default selection on that. You may want to know what that is, right? Because per stirpes means that it's going down to the kids of the people that you have named. If it's per capita, it's just being split with the remaining people that are on that list as beneficiaries. So make sure that you use those words, you look at those words as precisely as possible. We're going to take a break. We come back from the break. We're going to just kind of wrap up this conversation. Then we're going to bring in another one of our certified financial fiduciaries at Nelson Financial Planning, Garrett Fields, and we're going to be talking about PEs versus interest rates coming up next on Dollars and Cents. So talking a little bit on the program about what a will won't do, along with some of the tips that folks need to be aware of as they're looking through their various accounts, their various documents, because again, a will is not necessarily the determinative document on many different types of assets that are out there. It may very well be that beneficiaries named on those accounts, whether it's a retirement accounts, insurance accounts, things like that, or even state law can sometimes trump those decisions that you have made in a will. Remember, the will is a document of last resort that's going to be used during the probate process and not trump any of the decisions or the beneficiaries that you've named on a variety of accounts. So in the prior segment, we were giving some tips to make sure that you do it correctly. First and foremost, fill out the stuff properly, completely, and in its entirety. If it asks for someone's social, give it on the form, because that's important so that they can properly identify who in fact is a beneficiary. Use your words precisely. Primary beneficiary is different than contingent. Primary is going to take before the contingent. Per stirpes, down the bloodline, versus per capita among the group are two different terms as well. And a lot of beneficiary designations will have default options in there. So make sure you understand how those work. And then similarly, staying current, right? Current with life's changes. You don't want to name an ex-spouse as the beneficiary on an account, because that may not be what you want to happen to that money after you pass. And then a couple of last other points. Really minimize your estate, right? Because the estate process is a cost process. It's a time process. It costs a lot of money, takes a lot of time. So if you can minimize what's going through that process, then that really helps to reduce down the cost and the time associated with having those assets sort of settle into the people that ultimately you have named. Remember, name a person when it comes to a beneficiary. Name a person, not an estate. And obviously some exceptions to that concept, but again, if you name a person, then it's going to be able to go directly to that person much more easily than if it goes to the estate. Then it has to go through that process and then ultimately wind up with that person. And then lastly, don't wing it. Probably a bad idea, right? Yeah. I mean, Garrett does some flying, so you wouldn't really wing it and just hop in a plane and be like, hey, let's go.
No, and if you've worked this long and created this many assets, why whenever you get to that point, why wing it? Just fill it out correctly, put all the information that's required in it, make sure the process goes as smoothly as possible, because like you said, if it does have to go through probate, that's a very expensive and time-consuming process.
Well, and the other part of it is, look, oftentimes people's decisions in terms of who gets what are pretty straightforward, pretty easy, goes to my kids or whatever. But when it gets more complicated, then you need a specialist, much like if you had a medical problem that your general practitioner might not be able to solve. You'd want to go to a specialist in that situation.
And the thing about specialists is they're not normally cheap.
They're not cheap. No, that's exactly right. But you want to get this one right. So consider hiring the services of an estate planning attorney as well to make sure you get it all squared away. But certainly we've run into that at the office where, even naming beneficiaries on an account can start to raise some questions, primary versus contingent, per stirpes versus per capita. Some important concepts to make sure that folks think through.
Oh, absolutely. And just making sure that we explain to our clients that, hey, listen, whoever you name as beneficiary will supersede your will, because a lot of times there's a lot of misconceptions about that where people will name beneficiaries and say, oh, well, my will take care of it. Well, no, whoever you name here will get the assets after you pass.
And that can sometimes be a bit of a surprise to folks depending upon how things play out. So welcome back to the show, of course. You joined us here about a month or so ago, and so we'll circle you back around like we're circling the other members of the team.
Yeah, I'm glad it went so smoothly the first time that I got asked back a second time. So yes.
You didn't get thrown off. So you shared with me here this past week an interesting analysis that you did on sort of PE ratios versus interest rates. So I want you to kind of set the stage and sort of describing kind of what that analysis was, if you will.
Sure. So what we did is we went back over the last 80 or so years, and we took the average PE ratio of the S&P 500 per month, and then the average interest rate per month, and we ran a linear regression through it just to see if there was any correlation between the two.
Well, and certainly, from that perspective, there's been a lot of studies on it, and I know that what you found ultimately wound up sort of being confirming some of those other studies out there. But let's break it down a little bit more before we dig into that. So, kind of, when we think about interest rates, what are we talking about when we think about interest rates?
Sure. So interest rates are set by the Fed. They're not market based, and essentially the main interest rate that we looked at was the 10-year Treasury. So we took what the 10-year Treasury, the interest rate on that was every single month, and that's what we used. And historically, the average on a 10-year Treasury is about 4.6%. Currently, it's around 1.5, and actually in the I believe it was July, it was 0.5. So we're definitely on the lower end of interest rates, and based on what the Fed's been saying, we're probably going to start creeping back up here soon.
Well, and certainly, the Federal Reserve is the 800-pound gorilla. I mean, the market, the bond market, certainly can shift the interest rates to a certain extent, but that is a fair statement that interest rates are not really a purely market-dependent type of number. The Fed's the 800-pound gorilla in there.
Yeah, they have some pretty big control over what that's going to be.
And some deep pockets, because they got the printing presses. As long as those fellas don't run out of ink and paper, we'll be all right? But again, the stage on the historical basis for interest rates, interestingly, I think you shared with me like the average 10-year Treasury. So a 10-year Treasury is basically a loan to the government.
So what a 10-year Treasury is essentially you give the government $1,000, and then they agree to pay you a certain percentage every single month. So let's just take the interest rate of 5. If you gave the government $1,000, they give you $50 a year, and then at the end of that 10 years, they'd actually give you your $1,000 back. So you'd make, a 5% rate of return annually on that money, and then you'd receive the money back. That's kind of the gist.
In essence, a loan, which is true of any bond. A bond is basically a loan versus a stock, which is where I own a particular share of a company. And the average on that 10-year Treasury, nowhere near where we are today. We're at 1.5 today. That long-term average since 1871 is
4.6.
Yeah. So again, you see the disparity. So an interesting analysis when you start talking about, okay, well, with this interest rate environment, now trying to relate it to, okay, so what's going on with the stock market? So that gets to the PE ratio.
Yes. So is what PE ratio is, it's price over earnings. So whenever and we got to take a step back and remind viewers what buying a stock is. You're buying actual ownership of a company. So that makes you entitled to part of their earnings. So the PE ratio is how much money you have to invest into that company to be entitled to $1 of their earnings. So price over earnings. So if you have a PE ratio of 10, that means that you have to invest $10 into that company to be entitled to $1 of their earnings. If you have a PE ratio of 30, that means you have to invest $30 into that company to be entitled to $1 of their earnings.
So a great example of kind of how the PE ratio works. So what's some of the historical numbers of where are we today? And sort of what's the historical numbers as you kind of look at
Sure.
them?
So the historical PE ratio of the S&P 500 is right around 16. Currently, we're hovering around 33. So we're quite a bit ways above the average. But I mean, that's just where we're at.
Right. And so a lot of people look at the PE ratio as a measuring stick, if you will, of are we overvalued, undervalued? I mean, obviously at 33, I'm paying almost double what the historical average is for the same earnings.
Exactly.
That's in essence what that's saying. So that sets the stage for interest rates, PEs. When we come back from the break, we're going to talk about now that relationship, that regression, linear regression. Wow, we're talking linear regression on a Sunday morning.
And opportunity cost.
Opportunity cost. All right, all that and more coming up on Dollars and Cents. Talking about PE ratios, price earning ratios of a stock and the stock market in general, relative to interest rates. Set the stage in the last segment describing interest rates and PEs. So welcome back to the program here. at Dollars and Cents, Central Florida's longest running radio program. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries like Garrett Fields stands ready this week to help you change your life with a successful and cost-effective financial plan. So you did an analysis, a linear regression, Sunday morning, linear regression. Man, that's like, I need another cup of coffee to get through this.
I know, you just got to use, big words and people.
People start to pay attention. Okay, so you describe the analysis. So you took the PE ratios, average monthly PE ratios going back 80 odd years, took the interest rate on as measured by the yield on the 10-year Treasury going back that same 80 years, and you sort of put it all together, and what did it show?
Sure. So it showed that there's an inverse relationship between the two. So as interest rates start to go down, PE ratios will start to go up, and vice versa. As interest rates start to go up, PE ratios will start to go down. And as you start to think about that, that actually makes a lot of sense because of opportunity cost. So investors' two main vehicles, I guess, would be stocks and bonds. Well, if bonds are paying virtually nothing, aka right now, you're willing to pay a little higher, a little bit more of a premium to get into the stock market. So that makes a lot of sense that as interest rates start to go down, you're willing to pay a little bit more to get some level of return.
Well, and certainly from an investing perspective, right? That is the classic opportunity cost. If I can't get any real return on the bond side, then ultimately, because the bond side is sort of the fixed side, right? Because that's controlled by the Federal Reserve, not purely market driven. So the Federal Reserve holding interest rates down, in essence, creates kind of these higher PEs that people are willing to pay for. Because if you're looking for a return, that's really sort of the only way to sort of look for that. So as interest rates move up, PEs come down. Obviously, that's because of price potential decline, or those earnings increase as costs get pushed to consumers and things like that. So bottom line for us, I guess, Garrett, what should investors be doing now when we think about interest rates, PE, the conversation about, well, at this high of PE, almost double what the historical average has been, should I really be exposing more into the stock market? What's sort of some of the conclusions that we can draw on that?
Well, so this kind of comes back to something that we always preach, and that's pretty much be responsible, know what you own. Be comfortable with that, but if you own any type of bonds currently, as interest rates start to go up, those bonds are going to lose money. So, for example, if you have a bond paying 1%, so you gave them $1,000, they're giving you $10 a year. If interest rates were to go up to 2%, now all of a sudden, if you wanted to sell your bond, you would have to sell your bond at a price that $10 is 2%. So you'd have to sell that bond at $500. Now that's an extreme example, but you would have to sell it at a $500 loss. So, as we know, interest rates are going to go up because the Fed has already talked about that. But so just know what you own, know what your bond position is, and know if you need some liquidity, where else can you get it inside your portfolio?
Well, and once again, we hear that inverse relationship, right? So there's an inverse relationship between interest rates and PEs. Similarly, an inverse relationship between interest rates, and the price on a bond. So both of those inverse relationships, you think, that they'll track the same. There's actually an inverse relationship on that, and certainly with interest rates still low, and although they might be going up, it's going up from zero. That's still not much of a return. So I think the message is still you got to be a little careful on the bond side of things, particularly if you're going out on longer maturities like the 10-year Treasury or the 30-year Treasury, because they're much more susceptible to those interest rate adjustments. The longer the maturity, the longer the bond is, then that's much more susceptible to interest rates. So from an investment perspective, I think it kind of comes back to the notion of what we preach from an investment perspective of favoring larger companies, and I think there's some reasons for that.
Yeah, I mean, so as you have to move out of bonds to get some level of return, the equities that you own, you want them to be a little less volatile. And typically that is larger companies. Obviously they're not immune to decline or not immune to volatility. But the reality is that Amazon, Facebook, Apple, big giant conglomerates, they're not going anywhere. We saw that during COVID. We saw that during 2008. Most of those companies still stuck around. Whereas the smaller companies, particularly we saw this in 2020, they got hit really hard.
Right.
And whenever you're smaller, you don't necessarily have the resources or the backing to bounce back from things like a massive financial decline or a pandemic. Whereas companies, again, like Walmart, they have plenty of financial capital to bounce back. So just making sure that what you own is quality. Also make sure that you're diversified, because the reality is that every once in a while some of these big giant conglomerates, they do go out of business. But if you own multiple of them in your portfolio, one company going under should be a blimp on the radar. It shouldn't be a massive problem. So diversification and owning quality are kind of the keys going.
Well, and I think that also goes directly into, one of the things that particularly established large companies do, and that is this notion of paying dividends. Like if I'm an established company, I've got a solid business model, Procter & Gamble or something like that, then ultimately, I'm paying a dividend, and those dividends really do help to generate some income for investors, particularly if you kind of look at the dividend yield versus interest rates today.
Well, yeah, with interest rates being so low, the yield on the S&P 500's not much higher. I believe it's right around 1.5 currently. So roughly about the same.
Right. So you get the same yield, same money in your pocket on a basket of a stock portfolio that you would owning a treasury. So bottom line, as you said, diversification and really making sure that you understand the mix of investments that you have to dig down a little bit deeper. Can't necessarily draw broad conclusions just by kind of looking at PEs versus interest rates. You really got to kind of look at the environment that you're in, but dig down a little bit and make sure that mix is going to work in any type of climate, if you will. So some interesting stuff on PEs versus interest rates. Appreciate you sharing that on the program. You also do a lot of educational posting, stuff on Instagram, things like that. And from time to time, we take some of those and convert them over into blog posts on our website at Nelson Financial Planning. So you did a couple of late that we converted over to some blog posts. And so we wanted to kind of dig into those in our next segment. We're going to be talking about the one that you did about Robinhood, and then also the conversation about what it takes to be a millionaire. So we're going to shift gears and talk about those types of topics when we return here on the program. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, joined this week by one of our fellow certified financial fiduciaries, Garrett Fields, here on the program. So stay tuned through the break, and we will talk about how you too can become a millionaire. So in this segment, we're going to talk a little bit about some of the Instagram posts that our fellow certified financial fiduciary at Nelson Financial Planning, Garrett Fields, has done. And then we also like to take some of those and convert them over to blog posts we did with these two. So if you're interested in the blog post, make sure you check out nelsonfinancialplanning.com. So tell us a little bit about this recent one that you did about some of the studies that are out there in terms of how you too can become a millionaire.
Sure. So back in 1996, there was a book published called The Millionaire Next Door, and essentially is what that did is it went around and it did it sampled, or had a sample size of a couple hundred millionaires, and it looked at how they became millionaires and their path to building wealth. That book was highly criticized because the sample size wasn't high enough. Well, skip forward to 2019, and Chris Hogan, one of Dave Ramsey's ex-associates, actually published a book, The Everyday Millionaire. And he had a sample size of 10,000, so much larger. And the funny thing is that he found the exact same conclusions as the book from 1996.
Didn't matter the size of the sample, there was just some truths that existed no matter what. And what's interesting about some of these, as you're about ready to share, a lot of them are things that we think in our head that actually aren't really true.
Oh yeah, you take a look at the book, and most of people's perception of millionaires and how they got to that level is completely off. So for example, 74% of millennials and 52% of baby boomers believe that most millionaires inherit their wealth, and that's just statistically not true. 21% of millionaires, only 21% of millionaires receive any inheritance at all. Just 16% of that receive $100,000 or more, and only 3% receive an inheritance of $1 million or more. So only 3% of millionaires get to millionaire status through inheriting money, and 80% are self-made.
Yeah, well, that really sort of defies that logic of, wealth in America is created because it gets passed down from one generation to the next. That's not actually the case. The findings would say that is very different. Certainly there's that small section of 3%, that inherit $1 million and become millionaires that way. But the vast majority, 97%, make it the old-fashioned way by earning it. Now, well, they must earn high salary, right? I mean, they must earn high income, right? I mean, that has to be true, right?
That's statistically not true either. Statistically, only 31% of millionaires have earned over $100,000 per year, and only 15% of millionaires receive the status of CEO, CFO, or COO, the C-suits, as you will.
Yeah, I mean, so that's, not making over 100,000 and still, that just goes to the notion that if you're doing the right thing, saving money along the way, and doing it over time, then that's certainly important. And the other finding had to deal with college, right?
Yeah. So a lot of people think that to be a millionaire you have to go to this fancy school, get a fancy degree, and that's just statistically not true either. 62% of millionaires graduated from a public state school. Only 1 in 10 millionaires, so 10%, went to a fancy school. And I believe it was 1 in 10 didn't graduate from college at all.
College at all, right. Where'd you go to college?
I went to UCF.
And I went to University of Maine. So public school, there we go. So there's your plug for your public school, for your local public school. UCF was certainly local for you. University of Maine was local for me because that's where I grew up. But anyway, so for those that are trying to get there, what are kind of the 3 pieces of advice that we would say, hey, you know what, these are some of the key pieces, and the study sort of confirmed that Chris Hogan did. What are some of the three key pieces of advice, if you will?
So one of the biggest things is start now. As we preached on the radio show, compound interest, the 8th wonder of the world, said by Einstein, that is highly important. So if you start investing now, that gives compound interest that much more time to take effect, and it makes that number that much bigger. So that's definitely the first key. The second key is be consistent. Make sure that you continuously invest. And know that you're in it for the long haul. Don't get worried whenever there's a speed bump, once a year, or a speed bump every 10 years, or whatever. Know that you're in it for the long haul. And also, we hit about this in the previous segment, but diversification. Right. Most of the millionaires, they never contributed their wealth to one individual stock. It wasn't one individual stock play that boomed up. It's not like they owned Tesla or anything like that, and that brought them to millionaire status. Most of them had a well-diversified portfolio. They just, over time, grew at a normal 8 or 10%, and that got them to millionaire status.
Well, and it's certainly time in, not timing. Speaking of individual stocks and the risk that comes with that, another Instagram video that you did that we also converted over to a blog post on our website at Nelson Financial Planning. It had to deal with Robinhood, the individual company of Robinhood. Obviously, when we were on the program Best of Central Florida here about a month ago, on that television program on the local CBS affiliate and got the People's Choice Award. It was funny, the entire conversation, or a lot of the conversation, revolved around Robinhood because it had just gone public. So what's that process of going public, if you will?
Sure. So Robinhood IPO'd, initial public offering. That's whenever they take equity in the company and they divide it up into shares or stocks, and they essentially tell the public, hey, you can buy into us. So this is an opportunity for early investors to get out and for new investors to get in.
It's certainly an opportunity if I'm an early investor, because before I go public, I'm a private company, and it's not like I can just randomly sell my shares to get cash if I want to go buy a house or something. So one of the limitations of a private company is that oftentimes there's no way to get money for those shares. The process of going public is that way for the initial investors to sort of get their money out, and then for other folks that want to invest in the company, giving an opportunity for a much broader range of people to invest. So like there's a ton of people, millions of folks that have Robinhood accounts on their phone, things like that. I mean, is there any implication to them?
Not really. Just that you can own Robinhood while using Robinhood, which is kind of interesting. But no, the people that use the product, this really doesn't affect them much at all.
The point is, on any time you do an initial public offering, everybody it's gets everybody's attention. But the reality is, there's certainly a number of pitfalls involving owning an individual company.
And yeah, just like we preach about owning diversification, they're a perfect example of why you want to be diversified. On their first day, they dropped 9%. The next day, they went up about 10%. That level of volatility will cause stress of even senior investors. Now they're currently up 17%, but they're still down. They're still down about 25% from their high. So yeah, that's just stressful.
Well, a great thing of also knowing what you own, right? Because a lot of people were attracted to that stock because it had become very, very popular as a trading app, particularly over the past 18 months. But if you don't know what you own, then you may be surprised to discover it's got like a ton of class action suits against it as a company.
Oh yeah, in 2021, it had over 49 class action lawsuits against it. FINRA, I believe, just stepped in and gave it a $70 million fine. But yeah, it's
yeah, the importance of kind of knowing what you own, the pitfalls of an individual company. That all goes to sort of what we've been talking about in these past couple of segments, the notion of diversification and having that right investment approach. Right.
Yeah, and like we said earlier, diversification is the key to becoming a millionaire, or one of them.
Fascinating study, that is for sure, that Chris Hogan did when he was still part of the Ramsey Group, no longer part of that group. But certainly dispels a lot of those myths, and what's interesting is a lot of those myths are sort of even a template for some of the conversations that are coming out of Washington. This notion of, if you've got money, then you must have inherited it. I think that really kind of insults the folks that worked for it and earned it, and certainly that's the majority of millionaires.
Well, and what you also do is you shoot yourself in the foot, because if your idea of a millionaire is that they inherited it, you're kind of telling yourself, well, I didn't inherit it, so I can't get there, and that's just not the case at all. The reality is that Henry Ford once said, if you think you can or you think you can't, either way you're right. So if you're starting off the block saying, I don't think I can, it's probably not going to happen.
Great children's book, Little Engine That Could.
Yeah.
I think I can, and he made it. Anyway, with that, we're going to wrap it on up and get on out of here. We thank you all for listening to this week's program, this week's edition of Dollars and Cents. Thank you, Garrett, once again for joining us. We'll have to have you back again.
I'll be happy to be back.
All right. Well, very good. Thank you all for listening to the program. If you missed any part of it, I want to check out the video of the program, make sure you check us out on your favorite podcast channel or subscribe to us on our YouTube channel at Nelson Financial Planning. Have a great rest of your day.